We're the show that tackles those, super dense corporate reports, the financials, the footnotes, all that stuff, and we try to boil it down into something you can actually use. Today, we're diving into a really interesting player in the Turkish mining scene, CVK Maiden Ashlatmeleri Sanayi ve Ticaret. The ticker is CVKMD.
That's right. And our goal today specifically is for you, the individual investor. We're taking their consolidated financials and the operational report for the 9 months ending September 30, 2025, and we're translating it. It's not just reading numbers. We're looking at why things are happening, the stuff that isn't always obvious but really tells you about the quality of their earnings.
Exactly. We want to give you those key pieces of information so you're really informed about what CVKMD is doing right now. It's a pretty high-stakes game they're playing. And hey, if you find this useful, do us a quick favor, hit like, subscribe, maybe share it with someone else navigating these complex reports.
Okay, so before we even touch revenue or debt, there's something absolutely fundamental we have to get out of the way. It affects every single number we're about to talk about. We're dealing with hyperinflation accounting, TMS 29, the Turkish monetary standard.
Okay, yeah, let's unpack that because it really changes how we compare things, right?
Yeah.
What does TMS 29 actually make them do in this report?
Well, in a high inflation place like Turkey right now, just comparing last year's lira amount to this year's lira amount, it's useless, like measuring with a rubber band. So TMS 29 forces them to restate all the comparative figures. December 2024, the first 9 months of 2024, everything is adjusted to show the purchasing power of the Turkish lira as it was on September 30, 2025.
Right, so if we see a number from 2024 that looks way higher than maybe what was originally reported back then, that's just the accounting making it a fair comparison, like comparing real output, not just inflated numbers.
Exactly. We're talking inflation-adjusted real figures, but, and this is the big but for investors, the thing we have to watch like a hawkoosh, it creates this line item, net monetary gain or loss. Because of the inflation, depending on whether they hold more debt or more cash, they'll show these huge non-cash gains or losses. It's purely an accounting thing, not operations. And it can totally hide or even reverse what's really going on with the core business.
Okay. Net monetary gain or loss. We'll definitely keep an eye out for that one when we hit the income statement. All right, inflation context set. Let's lay the groundwork. Who is CVK Maiden? And maybe more importantly, what are they trying to become?
Okay, so they've been around a little while. Founded back in September 2006 as CVK Krom Maiden. Focused on Krom initially, as the name suggests. They changed to the current, rather long name in November 2011. But they only listed on Borsa Istanbul's Yildiz Pazar ticker CVKMD pretty recently, April 13, 2023. So an established company, but relatively new to the public markets, probably looking for that expansion capital.
And they're headquartered in Istanbul, Beşiktaş. But obviously the work happens elsewhere. What's their main business? Still just chrome.
Chrome was the start, and it's still important. Marble, travertine too. But they've really broadened out. They're heavily into base metals now, lead, zinc, copper, and also magnesite, and crucially, gold and silver. Plus, they're not just digging stuff up, they're actively buying and selling mining licenses. They're positioning themselves as like a growth platform for Turkish mining.
Okay, so that diversification. Sounds like they're trying not to be totally dependent on just chrome prices, maybe. Makes sense. Where are all these assets geographically?
That's definitely the strategy, yeah. And they're spread out. You've got key metal licenses, lead, zinc, copper, gold, silver, down in Çanakkale, near Yeniz, and over in Izmir, near Bayındır. Classic multi-metal zones.
But you hear a lot about CVKMD and gold, right? What's the deal there? Are the resource numbers actually that big?
Well, big needs context, but yeah, they're significant. The report points to Balıkesir, Sayalan specifically. As of May 2024, they're estimating, let me check the number, 538,625 ounces of visible gold reserve, plus another 25,000-ish ounces of probable reserve. Now, over 500,000 ounces. For a company that isn't one of the global giants, in Turkey, that's a substantial base that could support a mine for, decades.
Okay, so a major potential gold project. Plus the chrome they started with. You mentioned magnesite. What else is in the portfolio?
Right. They still have major chrome operations, Bursa Harmancak, Erzincan. And in Harmancak, besides chrome, they've got this magnesite estimate too, about 1.97 million tons. And you can see they're still expanding. They picked up new exploration licenses, Arama licenses, in 2024 and 2025. Places like Kayseri, Kütahya, looking for more chrome, iron, lead, zinc, copper. Management seems pretty confident about keeping these licenses too. They explicitly say they don't see significant renewal risk.
All right, so quite a few moving parts. How is all this structured? You mentioned subsidiaries, acquisitions.
Yeah, that's really key to understanding the balance sheet later on. They use full consolidation. So if they control 50% or more of another company, all its financials get rolled up into CVKMD's report.
And who are the big ones, the main subsidiaries driving this?
There are four main ones to flag. First, Harry Ogelman Medenslik. They own like 96% of that. It mainly does chrome, some trading. Second, Orda Truza Medenslik, 100% owned, focused on exploration, engineering. Now, this subsidiary, Orda Truva, holds another huge estimate. We're talking 4.58 million gold equivalent ounces. That breaks down into about 2.2 million ounces of gold, over 36 million ounces of silver, and a lot of copper, over 764 million pounds.
Whoa, hang on. 4.58 million gold equivalent ounces. That's massive. That dwarfs the 500,000 ounces at Siralin we just talked about.
It absolutely does. This is the potential game changer, the world-class asset they're trying to develop. Then third and fourth, they went international. They own 70% of Virtus Mining Ltd, placed in the Netherlands. And Virtus, in turn, owns Aldridge Mineral Medenslik. So CVKMD effectively owns 70% of Aldridge.
Aldridge.
Yeah.
Right. That name comes up a lot. That must be tied to some big acquisitions recently, yeah. What does Aldridge bring to the table?
Exactly. Aldridge adds another pile of resources. We're talking 3.465 million gold equivalent ounces there, made up of 1.2 million ounces gold, 40 million ounces silver, plus significant copper, lead, and zinc. So you've got these three big potential pillars, Saralanan, Orda Truva, and Aldridge. That's the investment story, really.
Okay, and connecting this back to the financials, all these acquisitions, especially for future potential, usually mean paying a premium, right?
Yeah.
Which shows up as goodwill on the balance sheet.
Perfect connection. If you look at Intangible Assets Note 18, there's this goodwill figure sitting steady at about 2.1 billion TL. The entire amount came from buying Virtus Aldridge back in 2024. So in inflation-adjusted terms, they paid over 2 billion lira more than the fair value of the assets they actually got. The fact it's still there, not impaired, means management, as of SEP 2025, still thinks those massive resource estimates are worth that huge premium. It's basically faith in the future payoff.
And are they hiring people to actually work on all this? What about personnel numbers?
Oh, yeah, big time. The parent company headcount jumped from 187 at the end of 2024 to 296 average for the first 9 months of 2025. That's quite a leap. Harry Ogelman grew, too, from 183 to 217 people. So, yeah, overall workforce is growing. They're definitely staffing up for exploration and development.
Okay, last piece on the company structure management and related parties, Note 5, I think. Anything jump out on exec pay or insider dealings?
Total benefits for the top execs, the board, was 17.54 million TL for the 9 months. Interestingly, that's actually slightly down in real terms from the 17.66 million they paid in the same period in 2024. Related party stuff. There's the usual, like some purchases and rent with a company called Itisler Tatlagi de Sanayi. But the more significant thing is the debt structure. As of September 30th, 2025, the company owed 234.8 million TL to Hussein Chevik. He's a key figure, a major shareholder or director, and that debt is up from 188.1 million TL at the end of 2024. So growing debt owed to a major insider. That's something investors should definitely keep an eye on. It can influence decisions down the line.
Okay, so we've got this picture. CVKMD holds massive potential resources, betting big on future development. Now let's see how the current business is doing. Income statement time. Starting at the top, Hasselot, revenue.
And right away, this is where we start seeing some problems. Revenue actually fell quite a bit in real terms. It went from just over 3 billion TL in the first 9 months of 24 down to about 2.4 billion TL for the same period in 25. That's a 20% drop in sales activity adjusted for inflation.
20% drop. Ouch. Did costs fall enough to match that? Cost of sales.
Not really, no. Cost of sales went down a bit, from 1.82 billion to 1.66 billion TL. But since revenue fell more sharply, brute CAR, the gross profit, took a really big hit. It dropped from almost 1.2 billion TL down to 731.5 million TL. That tells you straight away, margins were under serious pressure in 2025.
Okay, so the basic mining operation is making less profit on each sale.
Yeah.
Did they cut overheads elsewhere? Operating expenses?
A little bit. General management costs, marketing costs.
Yeah.
They both decreased slightly in real terms, so some cost control, yeah.
That core profit measure, Isas Valiat Karya, the profit from just running the mining business, that must have really suffered with the gross profit falling so much. How bad was it?
It was, yeah. Dramatically bad. Honestly, this might be the single most important number for understanding the current health of the business. Core operations profit crashed by almost 44%. It fell from 705 million TL in 9M 2024 down to just 395 million TL in 9M 2025. That shows serious fundamental weakness in their existing operations. They just aren't keeping up.
Wow, nearly cut in half.
Hmm.
That's alarming, especially given the huge investments they're making. Kind of confirms the story, doesn't it? They need those future assets because the current ones are struggling. Anything else dragging down that operating profit?
Yeah, there was also a big jump in other operational expenses. ESIS, Valley Etlerden, Dyer Gitterler, that went from 178 million up to 351 million TL. So that added even more pressure before we even get to the financing costs.
Okay, so less than 400 million TL profit from the core business. Now,
Yeah.
let's bring in the elephants in the room: massive debt and hyperinflation. Financing expenses must be huge given Turkish interest rates.
Oh, they are absolutely crushing. Financing expenses, check note 20 HODLs just exploded, skyrocketed. They went from about 191 million TL in 9M 2024 to, wait for it, 1.867 billion TL in 9M 2025, almost 10 times higher. It just shows the brutal, immediate cost of carrying all that debt for growth in this environment.
Okay, wait a second. Let me get that straight. They made 395 million in core profit, and then they had financing costs of nearly 1.9 billion. By my math, this should be reporting a massive loss, like over 1 billion lira. But the bottom line, Donum Kuri net period profit, it's only slightly down from last year. How is that even possible? Is this some kind of accounting trick?
It feels like it, right? But it's that non-cash item we talked about earlier, thanks to TMS 29. It's the monetary gain loss parasal kazan kayep, note 30. In the first 9 months of 2025, CVKMD reported a massive net monetary gain of 1.555 billion TL. That gain almost perfectly cancels out the huge financing expense.
Okay, simplify this for me and for our listeners. How does a company just gain 1.5 billion lira without selling anything or collecting cash?
Right, think of it like this. The company has way more debt, monetary liabilities, than it has cash and receivables, monetary assets. Most of that debt is either fixed in lira terms or it's in a stable currency like US dollars. When hyperinflation hits hard, the real value of the lira they'll eventually use to pay back that debt shrinks dramatically. They still owe the same nominal amount, but the actual burden of that debt gets lighter because of inflation. And since their debts are much bigger than their monetary assets, this difference creates this huge non-cash profit on paper.
So the 430 million TL net profit they recorded, it's not really from selling rocks. It's mostly because inflation reduced the real value of their huge debt pile. That sounds like low-quality earnings, totally dependent on inflation staying high.
That's the absolute key takeaway here. The net profit landed at 430.3 million TL, which looks okay compared to last year's 473 million. But if inflation suddenly dropped, that 1.5 billion TL monetary gain vanishes, and then you'd see the real impact of the weak operations and the massive financing costs hit the bottom line. Hard.
Okay, now let's talk about earnings per share, EPS, because that number just fell off a cliff. It went from 10.83 TL in 9M 2024 to just 0.34 TL in 9M 2025. That's insane dilution.
It really is the most stark number on the page. And it's almost entirely down to a huge change in their capital structure. Note 23.1 confirms this. Think of it like their original capital, 42 million TL, was a small pizza with only a few slices. Then in 2025, they massively increased the paid-in capital the size of the pizza to 1.4 billion TL. The total profit, the topping, stayed roughly the same, around 430 million. But now it's spread over way more shares. So that huge increase in the number of shares just crushed the EPS down to 0.34 TL per share. Each share gets a much smaller piece of the profit. Hashtag tax wafi, financial health and balance sheet review, liquidity, debt, and equity.
Wow. Okay, so income statement, struggling operations saved by an accounting gain. Let's pivot to the balance sheet because you mentioned liquidity risk earlier and working capital. This sounds like a big deal.
It is. So current assets look okay at first glance. They increase from 1.6 billion to 2.5 billion TL. But then you look at current liabilities, they jump sharply. From 4.5 billion TL up to nearly 6.7 billion TL.
Uh-oh. That does not sound like a good ratio. Assets up a bit, liabilities up a lot more. What's the actual working capital gap?
It's really severe. Note 2.b spells it out clearly. Short-term liabilities are higher than short-term assets by a massive 4.121 billion TL. This isn't just a small gap, it's a huge structural liquidity risk, a major red flag.
4 billion lira short. Management obviously knows this. How do they say they're going to handle it? How do they plan to cover that gap?
Well, the report says they're relying on future cash flow from operations and their ability to get more financing, but you have to question that, right? We just saw core operating profit dropped 44%, and they already have massive financing costs. So relying on more financing when debt is already high and relying on operational cash flow when the core business is weak, that feels like a very tight spot.
This is where the bet seems most risky. Do they at least have a decent chunk of cash on hand right now? Could that help bridge the immediate gap?
Yes, actually, their cash position is quite strong. Note 6 shows cash and equivalents went up from 737 million TL to 1.3 billion TL. And critically, most of that 1.26 billion TL worth is held in US dollars, which is smart, protects against lira depreciation, but it also adds currency risk if the lira were to unexpectedly strengthen.
Okay, let's talk about the debt itself. Note 8. We know it's big, but is it stable? What's the mix?
Total borrowings haven't changed much in real terms, around 2.7 billion TL, but the maturity profile has gotten worse. A big chunk of what used to be long-term debt got reclassified as short-term. That short-term portion jumped from 710 million to 907 million TL, which of course just adds even more pressure to that 4.1 billion working capital deficit we just talked about.
Right, more short-term pressure
Right.
on the currency.
Yeah.
You mentioned the USD debt helps with the monetary gain, but what's the actual split?
It's overwhelmingly foreign currency. About 2.1 billion TL equivalent is in US dollar loans. Only about 509 million TL is in lira loans. So yeah, that gives them the big accounting gain when the lira falls, but it means their actual cash outflows for debt payments are super sensitive to the TL-USD exchange rate, unless they're hedging effectively.
And the interest rates must reflect that split too.
Absolutely. The USD debt rate is manageable, around 6.67% average, but the lira debt, wow. The average effective interest rate on their TL borrowings is about 50.9%. That incredibly high cost is a huge part of why their total financing expense was 1.87 billion TL.
And to get all this debt, especially with the new assets, they must have put up serious collateral. Note 8 again.
Yes, substantial collateral, and it ties directly back to the acquisitions. For example, there's a big credit line, 1.66 billion TL or 40 million USD, used by Virtus Mining. And it's secured by mortgages on the land, the mine sites, and the licenses of Aldridge. So they're basically pledging the newly acquired assets to fund the debt needed to develop those same assets. It's definitely a high leverage play.
Okay, let's flip back to the asset side. Fixed assets, note 19. Does that confirm the big spending on development?
It does, absolutely. Fixed assets, Maddie Duran Varluklar, grew significantly from 11.9 billion TL up to 13.2 billion TL. That large increase clearly shows they are pouring money into capex buildings, machinery, equipment, everything needed to eventually turn those resource estimates into producing mines.
And lastly, on the balance sheet, equity note 23. Total equity went up, but you mentioned the structure changed dramatically because of that capital increase.
Right. Total equity grew moderately, 8.7 billion to 9.2 billion TL roughly. But the big internal shift, the one that killed the EPS, was paid-in capital jumping from just 42 million to 1.4 billion TL. That was mostly shuffling things around internally, moving value from accounts like share premiums. Also, there's a new positive item under other comprehensive income, about 213 million TL from foreign currency translation differences. That's basically the gain from translating the results of their foreign subsidiary, Virtus Mining, which operates in USD, back into Turkish lira for the consolidated report. So a positive boost there from the foreign holdings. ####V. Cash flow and critical footnotes, investor takeaways.
Okay, so we've got this picture. Operationally weak, huge liquidity risk. But then we look at the cash flow statement, and it seems weirdly strong. How can a company with a 44% drop in core profit and a 4 billion lira working capital deficit be generating so much cash from operations?
This is where we see how they're managing, or maybe mitigating, that short-term risk. Cash flow from operating activities was huge, 2.55 billion TL positive for the first 9 months of 2025. That's way up from 783 million last year and much, much higher than the 430 million net income.
Okay, so low quality earnings, but high quality cash flow. What's driving that huge difference?
It's almost entirely down to changes in working capital, specifically one big liability line, deferred income, or ertelenmiş gelirler. Notes 15 and 6 show this account grew massively by 2.36 billion TL during these 9 months.
Deferred income. Okay, break that down. How does owing more money actually generate 2.3 billion in cash today?
It's basically getting cash up front for something you haven't delivered yet. Think of it as advance payments from customers, maybe, or other future commitments they got paid for now. Like maybe a big customer paid them today for 2 years' worth of Chrome deliveries to lock in a price. CVKMD gets the cash, immediately huge boost to operating cash flow, but they haven't earned that revenue yet, and now they're obligated to deliver that Chrome later.
Ah, okay, so it's a short-term cash fix. It helps them pay bills now, but it means they've already booked the cash for future work. And it makes that short-term liability problem, the working capital deficit, even bigger on paper. Cash today, obligation tomorrow.
Exactly. It lets them fund their massive capex, which we'll see in a second. But it means future profits will be lower because they have to cover the costs of delivering on these prepaid deals without getting new cash for them.
Right. Speaking of CapEx, investing activities cash flow must show that spending, right?
Confirms it completely. Investing activities showed a massive cash outflow of 1.6 billion TL in 9M 2025. And almost all of that 1.7 billion TL was purchase of tangible assets, equipment, infrastructure. They are absolutely funneling cash, including those advance payments, straight into building out the mines.
And financing activities. With all that debt, were they borrowing more or paying it down?
Actually, financing activities showed a net outflow of 292 million TL. That's a big change from last year when they had a 1.16 billion inflow. What's happening is they paid back a lot of debt principal, 1.17 billion TL, and paid significant interest, 280 million TL. That outweighed the new loans they took out, which was about 1 billion TL. So they are actively managing and paying down parts of that huge debt pile, which eats up a lot of cash.
Okay, quickly on the footnotes, anything else critical under contingencies?
Yeah.
That deferred income liability seems key.
Yeah, deferred income is the big one to watch, 2.3 billion short term, another 200 million long term. That's the future obligation they need to work through. On a smaller positive note, short-term government receivables, and mostly VAT refunds, KDV, climbed to nearly 100 million TL. That usually means high exports or lots of investment spending generating those refunds.
And what about those old lawsuits? The Aldridge land disputes. That was a big cloud hanging over them, wasn't it? Notes 10 and 21.
Yes, and that's actually some good news here. The provision, the money they had set aside for potential losses from those land lawsuits, it dropped dramatically. It went from 285 million TL down to just 2.5 million TL. That strongly suggests they've settled those cases or won them. So a major historical risk, almost 300 million TL worth, seems to be off the table now. #tag show sex. Synthesis and final thoughts for the learner.
Okay, we've gone from massive goal potential to a 4 billion lira liquidity crunch. Let's try to wrap this up for the individual investor. What are the absolute key takeaways, the big positives and the really scary challenges?
All right, positives. CVKMD is loaded with assets, potentially world-class resources, those millions of gold equivalent ounces. They are actively developing them. They also have, right now, strong cash reserves, thanks mainly to those advance payments, which lets them fund the CapEx. And resolving that big lawsuit is definitely a plus, removes uncertainty.
So they have the potential prize and the cash for now to go after it. But the challenges, they seem pretty immediate and serious.
They are immense. Number one is the earnings quality. That 44% drop in core operating profit is real, and it's being hidden by that huge non-cash inflation gain. That's not sustainable profit. Number two is that critical 4.1 billion lira working capital deficit. That's a major, major liquidity risk. Combine that with the heavy reliance on USD debt, it makes them very vulnerable to currency swings and interest rate changes. They're definitely prioritizing future growth over current financial stability.
So the story really is, it's a massive bet on the future, pouring everything into developing these huge new assets while the existing business struggles significantly.
It's basically a race against time. The whole investment case depends on them bringing those new assets online, generating real cash flow fast enough. The current profit is flimsy, relying on inflation accounting.
Which brings us to our final thought for you, the listener. If you mentally strip out that 1.5 billion lira monetary gain, the non-cash inflation benefit, what you're left with is a core business that isn't really covering its costs, especially not its huge debt costs. So the big question isn't just about the next quarter's earnings, it's whether these massive investments in new mines can start generating significant, real, sustainable profits quickly enough to fix that core business trend before the short-term debt comes fully due and that temporary cash cushion from advance payments runs out.
That's it exactly. It's the definition of a high-risk, potentially high-reward mining development story. The upside could be huge, but there's very little room for error.
An essential perspective for anyone looking at CVKMD. Thanks for breaking down such a complex report into something we can actually grasp.